Welcome to Safe Option Strategies presentation of adjusting the bear call spread. This class is a production of Safe Option Strategies and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks and options comes with risk, and you are solely responsible for any losses you may incur as a result of trading. All right, let's review the bear call spread, and I want to, and let's go through this quickly, and then I want to kind of pick up with where I left off yesterday. And here's what I mean by that. Let's review what the bear call spread is real quickly. It's a credit spread. The net result of opening this trade is money into our account. We sell to open the trade, we buy to close it. A short call is placed out of the money, and it needs to be at or above a strong level of resistance, preferably above. In the current or next month or week of expiration, we don't want to be more than 4 or 5 weeks out in expiration. A long call is then placed one or more strike prices higher and in the same month or week of expiration. The important thing is the same expiration date. That is our secondary or our hedging option. Our cost basis is whatever credit we take in on the opening of those two options subtracted from the difference between our strike prices. That's what our max risk is. We cannot make more money than the net credit of the trade without an adjustment. And a good target return on risk can be anywhere from 20 to 50% on a rare occasion. And a very rare occasion, we might be willing to target 15%, but that would need to be a 2 or 3 week trade, maybe a 1 week trade. Otherwise, we're going to try to target a minimum of 20%. Now, yesterday, well, when we did it live, it was yesterday. I should say in the previous class, because if you're just listening to all recorded classes, you would of course have no idea it was yesterday. When we did the previous class, the bear call spread, we ended the class talking about how we don't do a lot of bear call spreads. As we go through the adjustment process, as we learn the adjustment process, from the perspective of the difficulty level to adjust this trade, that is one reason why we don't typically do bear call spreads, or don't do a lot of them. It is a difficult trade to adjust. The other reason is what I want to sort of go back to from the ending of the previous class, and that is people that invest in the markets by nature are not pessimists. A willingness to invest money in the market means that you have an optimistic outlook on the ability to grow your money. You believe you can grow your money. And it's hard to get in this mindset of looking for bearish trends to make money on, especially when the overall market trends are bullish. Our tendency is to kind of turn away from the losing companies when the markets are overall bullish. Now, this can change a lot when the markets go overall bearish. We have not had a full-on bearish market since 2008. The U.S. stock markets are up over 175%. The market indexes over 175% up since the recovery began in early 2009. It is unprecedented growth that we have had in our markets in the past number of years. That's not going to last forever. There will be a time when we shift back to bearish markets. And when that time comes, I'm not even going to say the word if, when that time comes, you need to know how to do these kind of trades. So I want you to put this in context. When I say we don't do a lot of bear call spreads, we haven't had a lot of opportunities for bear call spreads. That will change. We will find opportunities when this is going to be one of the best trades you could possibly put on. Hasn't been the case for a while, and that's okay. But we're here in this class right now to focus on how to adjust this thing. When a bear call spread moves against you, how do you adjust it? So we get our bear call spread set up. Maybe we're at the 155, 160 strike prices. I know these don't line up perfectly with the prices over there on the far left. But we get our trade set up, and our expectation is that we're going to get a bullish or excuse me, a bearish, sorry. We're going to get a bearish or maybe a stagnant movement. We're perfectly okay because of the way time decay works. If the stock just kind of meanders around here, but it doesn't go above the strike price of our short call, it's okay if it's just in a stagnant trend. There's nothing wrong with that. Our preference would be a bearish trend. We'd like to see this thing moving down. So we open the trade. We get a reversal. Suddenly the stock is moving up. As I go through the adjustments that can be made to this trade, as I go through these adjustments, I want to emphasize right up front here that we are going to go in reverse order of the most preferred adjustment to the least preferred adjustment. I'm actually starting right now with the adjustment that I would go to last. Okay, this would be my last adjustment to make. We could roll all of the options, well, both of the options, there's only two of them. We could roll both of the options out to farther expiration dates and up to higher strike prices. Chances are to do this and still be in a credit spread, we're going to have to increase the distance between these strike prices. If we started out with a $5 difference between the strike prices, we might be forced to move to a $10 spread in our options for the purpose of getting as much or more credit on the new bear call spread as what we spent to close the old bear call spread. Up until this point in the education, you have heard me say on many occasions, the number one rule when we roll a short option, get as much or more credit on the new short option as what you're spending to close the old short option. That's our number one rule. That's our goal. Apply that goal to the entire trade when you're adjusting a bear call spread. We want to get as much or more credit for this bear call spread as what we're going to spend right now to close this bear call spread. It is almost impossible to do that by only moving farther out in time. You have to, well, I take that back, scratch that. I said that wrong. It is almost impossible to do that by rolling farther out in time and increasing the strike prices without increasing the difference between the strike prices. In other words, going out, we have to go up because the stock is trending up now. We want to get these options up and out of the money. That's our goal. Get them out of the money. It doesn't do us a lot of good to just roll them out in time, but leave them deep in the money. So we've got to get them out of the money. Getting them to higher strike prices and out of the money and moving them farther out in time. It is almost impossible to get a bigger credit right here, or as much credit right here, as what we spent right here, and not have to increase the distance between these strike prices. And what happens when we increase the difference between the strike prices? We increase our risk. If you increase the difference between the strike prices, you naturally, automatically increase the risk. Okay? And I've got right here on the last bullet point, this is not the most recommended adjustment. Sometimes it's the only adjustment. When I say it's not the most recommended adjustment, it's still an adjustment to a trade. It still may be a lot better than taking a loss. But it's not the first recommended adjustment. So we get in a trade, we get Home Depot here. We'll just use Home Depot for an example today. We get Home Depot. It gives us technical crossovers. It shoots to the downside. We see what we believe is a strong level of resistance. Remember when we talked about setting up the trade? We want identifiable technical crossovers, and we want an easy to identify and easy to see level of resistance. And then we set the strike price of that short call at or above that level of resistance, and we place our long call higher. And then if we get this reversal and now the stock is suddenly going up, we can roll both options out to farther expiration dates, up to higher strike prices, and we're probably going to have to increase that distance between the strike prices. Now, a lot of times I get the question, so I'm going to preempt it and just share it with you. A lot of times people say, when do you make that move? When do you make that move? When you have technical crossovers that show you that the stock is now moving into a bullish trend and you get a break through this level of resistance. That's when you make the adjustment to this trade. And that's why it's a really good idea when you open this trade, if at all possible. And if this is not possible, reconsider opening the trade. You want there to be a little bit of distance between the strongest level of identifiable resistance and the strike price of your short call. You don't want that short call sitting right on a level of resistance. If that's going to be the case, reconsider doing the trade. It may not be as good a trade as you thought if the only way to get a decent credit is that you put that short call right at that level of resistance. Because I would like to see technical crossovers showing me that I'm moving into bullish territory and a break through that level of resistance, and still not quite see that short call in the money yet, only getting close to being in the money. That's when I'm making the adjustment. And we roll the options out. A lot of times with your broker, you're going to have to roll the long call first. You're not going to be able to, if you have to roll this in two different steps. Now, if you have a broker that will let you create an all-in-one ticket and do the close, you know, the sell to close, buy to open of the long calls, and do the buy to close and sell to open of the short calls, and you can do that all in one 4-leg transaction, do it that way. But most brokers are going to make you do this one leg at a time. You're going to have to roll your long call first. You can't roll a short call out past the expiration of your long call because it will be considered a naked call, even just for the few moments that you're trying to adjust it. Okay, here's what it might look like with real money. Cost basis, money in, money out. Keep track of the money in, money out. If we had to buy, notice these two options, the 150, the 145, they're both in the money now. If we had to buy to close our September 145, okay, remember this started out as the one we took a credit in on, and this started out as the one we paid the debit on. So we're going to buy to close that September 145 option. That's going to cost us $9.25 right now. We have to sell to close the long option, which is the 150. That's going to cost us $5.80. It just cost us $3.45. It just cost us $3.45 to close this trade. Okay, we just spent $3.45. Anyone not with me on that? We just spent $3.45 to close this trade. If we want to maintain the original credit we opened this spread for, let's say hypothetically when we open this spread, let's say we took in a credit of $1.15. If we want to maintain that $1.15 credit, we have to be able to open our new bear call, the one we're rolling to, for at least a $3.45 credit. And in order to do that, we're probably going to have to go to a $10 difference between our strike prices. There's no way we can get $3.45 credit with strike prices only $5 apart. It's just not going to happen. Or if it happens, it's going to be such a, if you can make it happen, that's great. Let me be really clear on this. If you get a scenario where you can roll both options out to a farther month of expiration, both of them up to higher strike prices, get them out of the money, and you can get the same credit on the new bear call as what you're spending to close the old bear call, and you don't have to increase the strike price difference, do it. That's a great roll. I have found those situations on very rare occasions. Very rare occasions. I don't find them much lately. You're probably going to have to increase the spread between your strikes. Now in this case, we took in a little bit of additional credit. We did a little bit better. We spent $3.45 to close and we took in $3.73 to open. That's wonderful. That's fantastic. We improved our credit by 28 cents in this trade, but in the process of doing that, we increased our risk by an additional $5. If in our scenario, we hypothetically said, what if we'd taken in a 115 credit originally? Well, now we've got a 143 credit, and that's great, but we have a $10 spread. And what's a 143 credit? A $10 spread minus a 143 credit, that's $8.57 per share at risk now. 143 divided by 857. We could still make 16% on that trade. But you're taking on a lot of additional risk. Remember the emphasis we put in the bull put spread class and the bear call spread class. We talked a lot more in the bull put class, but in the bear call class, we also talked about our option requirement. You are increasing your option requirement by by double. You're increasing your option requirement by double. Don't forget, when you start this trade, and you're doing 10 contracts and you need $5,000 liquid in your account for your option requirement, okay? Don't forget that you might need another $5,000 liquid in your account to be able to pull off an adjustment. And when you open this trade and you know this amount of money is going to be tied up, if you don't have this amount of money in cash in your account, you better lower the number of your contracts that you're doing. You better make some changes in the number of contracts you're doing to make sure that there is money set aside for the possibility of that adjustment. All right, let's talk about another adjustment we can make. Same scenario. We get our trade set up. We're hoping for that stagnant or bearish movement. We instead get the bullish movement. We can simply add long calls to this trade. If we're breaking through what we think is a pretty strong level of resistance, and the next level of resistance is way up here, the quick addition of more long calls puts us into a call ratio back spread. That's a trade we haven't even taught yet, but it puts us into a call ratio back spread, and more long calls are going up in value, which is a good thing, than short calls going up in value, which is a bad thing. And these can offset each other, or at the very least offset some of the maximum loss. It could possibly yield a profit, but chances are you're doing this as a means of offsetting taking a big loss. So we get our technical indicators that are all lining up. We have our identifiable level of resistance. The stock moves down. We get the crossovers. We get the push through resistance. Hopefully there's still a little bit of room right there before the short call is in the money, and we preemptively add a long call because our next strong level of resistance is up here, and these long calls could trend in the money, and we could get out of this trade with a lot less of a loss, or maybe even a little bit of a profit. If our original credit in a trade was 245 and we suddenly went out and spent 275 for additional long calls, if they were the same number of contracts, we just changed our trade from a credit spread to a debit spread. And we need to factor that into everything we do moving forward now. Now, one additional note right here. When we add that long call, the temptation is usually to put it right in the same expiration date as our other options. We can go farther out than that if we need to. We might be willing to pay a little bit more, turn this into a debit spread, and go farther out in time. What kind of trade do we have open at this point in time? Well, we still have a bear call spread open, but the addition of those longer term, those farther expiration long calls, they kind of change the scenario. We've now got a bear call calendar and some naked calls, or a bear call and some lone long calls, some directional long calls. But we could very easily, if we wanted to, change this into a bear call or a call calendar if we rolled our long calls out rather than just add new long calls. So there's a little variation. You could actually roll your long calls out instead of just adding new long calls. You will add debit to the trade doing that, most likely. So it has a similar net result, but now you're in a calendar spread, and you can adjust this option up or down as the stock moves accordingly. You can roll this one out and up, out and down. You have a few more choices with how you can do that. Now, I told you I was going in order of the least desirable trade or the least preferable trade adjustment to the most preferable trade adjustment. The absolute best adjustment you could make for a bear call spread that goes against you, so same scenario, now it's going against us. Before the stock price has moved too far above the strike price of our short call, preferably before it's moved above the strike price of our short call, we buy stock. We buy stock as close to this strike price as possible. A little bit below it, a little bit above it, right at it, doesn't matter. We buy stock as close as possible to our short call strike price. Okay? Then we allow the stock to get called away from us at that short call, and we close our long call and take anything we can get for it before it expires worthless. So we've got our trade set up, and we get these technical crossovers, and we get a break through our level of resistance, and hopefully there's a little bit of room between our resistance level and our stock, and somewhere in this little bit of room. Now, a lot of times when we get a breakthrough resistance, boom, in the blink of an eye, we're right up here. So we don't have much time to act on this. If we've technically crossed over and we've broken a level of resistance, before we've gone past the strike price of that short call, or before we've gone very far past it, a little bit above, a little bit below is fine. We try to get the stock. And then knowing that within a couple weeks, because this is only going to be a few weeks out in expiration, right? It's only going to be 3 or 4 weeks out in expiration when we start the trade. So by the time we're making adjustment, probably it's down to a week or so. We're only going to hold that stock for a week before it gets called away from us. But if we don't have the money set aside to own that stock, we cannot make this adjustment. Question just came in, what if we buy the stock and it doesn't get called away from us? Then if it doesn't get called away from you, that means all of this will have expired worthless. Whoops. That means all of this will have expired worthless. If this is in the money, the stock will get called away from you, even if you bought it a little bit higher. This will call your stock away from you at expiration unless the stock remains below here. And if you get your full credit on here, I keep accidentally hitting the, sorry. If you get your full credit right here, then sell the stock. You take your full profit here, and hopefully you sell the stock for pennies above or pennies below where you bought it from. If you make this adjustment, the odds are that that stock price is going up through the strike price of your short call, and getting called away is probably a foregone conclusion. It's a good question because it's possible that you preemptively buy stock somewhere right in here, and before it actually crosses through this strike price, it sort of flattens again. Great. If the stock price doesn't go above this short call strike price, this is going to close with full profit, and you dump the stock before it goes below where it was at. When you get down to that, a lot of times this adjustment is going to take place when you're down to about a week before expiration, and your chances of getting called away start going up exponentially in that final week. It's rare that a short call, even one that's in the money, gets called away prior to the last week or week and a half before expiration. But oftentimes that's when you're making this adjustment. So the chances of it getting called away are very high. When the stock in a bear call spread moves to or above the strike of our short call, when it's broken a level of resistance, when it's crossed over technically to the bullish side, our first best adjustment would be to buy the stock as close as possible to the strike of our short call, allow it to be called away from us, and then sell to close our long call. Our second choice would be add protective long calls or roll out to a calendar. I need to add that in the bullet points next time I do this. Be very careful of your cost basis and your risk if you decide to roll both options out and up. This would be the third possible adjustment. I think next time I do this class, I'll change these bullet points a little bit. Always keep track of your cost basis and how it's going to change as you roll options. And be careful entering bear call spreads. We use them seldom for the reasons that I outlined. I don't need to rehash those reasons. But we use them seldom. We're careful when we use a bear call spread. Sometimes it is the best trade to put on, and I do use them. I don't use them a lot. Folks, that wraps up Adjusting the Bear Call Spread class. Thank you for joining. Have a great day.